For income investors, the hardest decision isn't when to buy, it's knowing when to let go. We get attached to the steady income, but loyalty can be costly. The core rule, however, is beautifully simple. You sell when a stock can no longer deliver on the expectations you had when you bought it. Making that call requires a system, not a gut feeling. And that system starts the moment you click buy. Before you do anything else, you must document your thesis. Write down exactly why you own this specific stock. Markets move fast, and our memories are faulty. For most dividend names, the reasoning is clear. A typical thesis might sound like this. I'm buying stock XYZ because it hasn't cut its dividend in years and has consistently raised payouts. I expect that stability to continue. But that expectation is just a hope unless it's supported by hard facts. Your confidence in future dividends has to rest on solid, verifiable fundamentals. This means checking for 3 pillars. First, a strong balance sheet with reasonable debt and plenty of cash. Second, sustainable earnings power, meaning profits and cash flows clearly show the company can fund its dividend from its own operations. And third, credible long-term growth potential, backed by a resilient business model and a realistic management team. As long as these 3 pillars remain intact, you usually don't need to do a thing. However, you must also define your tripwires in advance. What specific events will force you to reassess the stock? Write these down too. The first trigger is the most obvious, a dividend cut. If stability was core to your thesis, a cut is a fundamental breach of contract. The second is more subtle, several years of flat dividends when you were expecting consistent raises. This signals stagnation. The third trigger is severe market underperformance. Compare the stock's decline from its 3-year high with the overall index. If the gap between them exceeds 30%, it often signals a deep structural issue, not just a temporary dip. If one of these alarms goes off, your expectations are no longer being met. It's time to investigate. This is when you put on your detective hat. Dig into the primary sources, earnings releases, investor presentations, management calls. Then broaden your view with industry news and reputable financial media. Compare the situation today with your original thesis. Does the company still have that strong balance sheet? Does it still have sustainable earnings power?
Is management still on track? Because one truth never changes. Without growth, dividend stocks stop creating long-term wealth, no matter how long you hold them. If the outlook has fundamentally deteriorated, you replace the stock. Just as important is knowing when not to sell. Discipline means ignoring the noise. If a dividend stock hasn't cut its payout, hasn't signaled a cut, and hasn't materially underperformed the market, there is zero reason to sell. Not because of an analyst downgrade, not because of a friend's hot tip, not because of a single negative headline. Selling without a fundamental trigger is just abandoning your strategy. The only legitimate exception has nothing to do with the stock itself. You need the money for a major life goal. That's a life decision, not an investment decision. In all other cases, you stay invested. Whatever you decide, make the decision consciously. Either actively hold or actively sell. Doing nothing is rarely a strategy. You won't always be right, that's just part of investing. But thoughtful decisions compound. Hope does not.